Okay, good evening, everyone. Welcome to another episode with Sequoia Lending. If this is the first time that you are here tonight, Sequoia is a commercial lending platform. We service small businesses across the country, whether it's a fix and flip, whether it's a 1 to 4 unit investment property, or equipment loans, or buying of businesses, or construction, whatever that might be. As long as the project makes sense, we might have the right product or right loan to service these clients. Okay, so that's what Sequoia is all about. And feel free to connect to us on our Facebook page, on our YouTube channel, Instagram. We are on social media, very easy to find, and we are also all over the United States. So I'm sure that no matter where you are, you will we will have some Sequoia member in that state. So what are we going to talk about today? Many of you know the interest rate has dropped. Well, I shouldn't say dramatically, but dropped since August. Okay, and we see a lot of clients that used to be sitting on the sideline and now they are coming into the market to purchase investment property. So the rate drop, they are dropping the prime rate. The prime rate is today at 8%. Okay. If you want to do a search, I suggest you everybody do a Google search on the prime rate. But however, a lot of this 1 to 4 unit investment property, they follow something called 5 year treasury or 10-year treasuries, depending on which lender and depending on where the money come from. So we have been quoting the prime rate is the 5 year treasury 10-year interest rate somewhere around 3 or 4% right now, very low. So we are quoting somewhere between 5.5%. Yes, that interest rate has not heard of for a long, long time. So the lowest I've ever seen is about a 5.5% interest rate, all the way to about 7%, somewhere around that range. But majority of the loan that we are quoting, it's somewhere around 6.5% right now. So compared to not a year ago, compared to just like 3 months ago, 4 months ago, the interest rate has dropped at least a point and a half. So that's why a lot of the clients are coming into, um, to stop buying properties or refinance properties, so on and so forth. So that is what we have been seeing. So tonight, one of our loan advisor or processing manager, George, he's also here. He's going to share with us what is he seeing because he's very busy with his team in the back end. And in the front end, we see a lot of loan officers closing deals left and right. And we are now averaging closing one loan a day. Um, we want to get a little bit more, but one loan a day, well, obviously just Monday to Saturday, right? So one loan a day, you're averaging out to a month. That is good about 22, 23 loans a month. So we are very, very busy right now. Okay. So along this line, what I'm going to talk about is that a lot of the client or agent, once they submit the loan to us, now they start asking us, hey, what is the interest rate? What is the mortgage payment? Okay. So tonight I'm going to share with everyone that how do you calculate the mortgage payment without asking us? If you ask us, yes, we can definitely do it for you, but it will be much, much, much faster for you to do it on your own. It's not that difficult. It's very, very easy. And that is part of the commercial basic as a loan consultant you should know about. Okay. So now when we're talking about calculating the mortgage, we need to know what type of mortgage out there. Without going into too much detail, all I can tell you is that in terms of the payment wise, we have two different type of mortgage. We have something called interest only and amortization mortgage. So interest only is something, it's just like the name said. It's interest only. You do not pay principal. You only pay interest on a monthly basis. Amortization is different. Amortization is that every single month you will pay the monthly payment that you pay, including interest and what? And principal. Okay. So we're going to be talking about both this type of loan, interest only and amortization. So let's talk about interest only first. We all know interest only, it's no principal, only paying interest. You will see something called 3-1 interest only, 5-1 interest only, 5-6 interest only, 10-1 interest only. What in the world does it mean? So the first number that you see, okay, the first number that you see, that is representing the number of year. When you look at 3-1 interest only, it means that this loan is good for 3 years. And in the next 3 years, the interest rate would not change. If I quoted you 6.5, it's going to be 6.5 for the next 3 years. Okay? Now, what does that one mean? So normally when we quote a loan to someone else, it's normally it's a 30-year loan. 30-year loan. Okay? 3-1 means that for the first 3 years, the interest rate does not change. Now, after 3 years, what happened? The rate is going to adjust every year. So that's what that one means. Every year, the rate is going to adjust, assuming the client does not refinance the loan. He wants to keep the loan. So again, every year the interest rate will adjust according to the market rate at that time. So now, let's say today I quoted you 6.5. Let's say 3 years down the road, the interest rate dropped. Let's say the market rate is at 6%. So what happened to the interest rate? The interest rate is going to drop to 6%. So the mortgage payment will drop from 6.5% down to 6%. Does it make sense? So that is what it means, 3-1. Same idea with 5-1 interest only. 5-year fix, interest rate does not change. Every year, the interest rate will change according to market value. 10-1 interest only, same idea. What about 5-6? What does it mean? What does the 6 means? Anybody can take a wild guess what the 6 means? 6 means every 6 months, not every 6 years, okay? 6 is every 6 months. So 5-6 means that for the first 5 years, no change. After that, every 6 months, the interest will change one time, will adjust one time. So that is what this type of payment is. Now, how do you calculate the mortgage payment? This type of interest, this type of payment is what we call simple interest. So for those of us who take math in college, right? Calculus, we study about interest. So it's a simple interest, very easy to calculate. So how do you calculate? That is the formula. The monthly payment equals to the principal. What is the principal? 100,000, 200,000, 300,000, whatever that might be, times the interest rate. So if I quote you the interest rate is 6.5%, that is the interest rate. And then when you use the principal times the interest, what is that interest? That interest is a yearly interest. So if I quote you 6.5%, that means that year you will pay 6.5% on a $300,000 loan. So when you use $300,000 times 6.5, that is the total yearly interest payment that this client needs to pay for an entire year. Does it make sense? Now, if you want to calculate the monthly payment, you just use that, whatever the dollar amount is, divided by 12. So let's do a calculation. Anybody can see my calculator? Are you seeing my calculator? Yes or no?
Yes.
Okay, good. So let's use the example, $300,000 principal times 6.5% interest rate. So what does it mean? It means that year, this client needs to pay $19,500 that year for interest. Now you divide it by 12, the monthly payment is $1,625. That's simple. So you don't need to ask me anymore. It's just that simple. Okay? Punch in the calculator, use the principal times the interest divided by 12. Now, you might ask, who would use something like this? There are many, many different reasons people would love to use interest only, including myself. Personally, I am This interest only product is one of my favorite product. All my properties are only interest only. I do not pay the principal. I only pay interest. Okay. So why is it like this? It's because when you pay the payment, you do not pay the principal. What happened? You pay less monthly payment. So which means to increase your what? Increase your loan amount. Okay, increase your loan amount. So a lot of people, well, the way that we determine loan amount is what? It's based on something called DSCR. I talked about that in another training already. So if you want to watch it, go back and watch what DSCR is. DSCR basically stands for debt service coverage ratio. Debt service coverage ratio. So you can do a Google search or YouTube search on DSCR, and you can. There's so many people talking about it, so I don't want to continue. I'll repeat what they say. So we determine the loan amount based on DSCR. Now, what is DSCR? How do you calculate DSCR? Basically, it's the income divided by what? The expense. What is the income on the property? Rental income. You have a $300,000 home, you rent it out for $2,000 a month. That is your income. Now, what are your expenses? Your expenses including what? Property tax, property insurance, and what? Mortgage, right? Mortgage. So now I know the income, I know the expenses. Now I can calculate what? I can calculate your DSCR. Okay. Now, with that being said, then I can do a reverse. If I know what the DSCR is, then I can calculate what the mortgage payment is, right? So now that is what we use to determine what the total LTV is. So I know what the DSCR is, then I can tell you what the LTV. LTV stands for loan to value. In that case, I can tell you how much money that you can borrow from this property to meet this DSCR. Okay. Now, if it's too confusing, it's okay, right? So if the if the expense become less, so let's say if the mortgage payment become less on a monthly basis, what happened to the LTV? The LTV can increase, which means that I can get more money out of this property. Does it make sense? So that is why a lot of the investors, they love you to use interest only product to so that they can get more money out of their property. Okay. So that is how you calculate interest only. Easy enough. Am I right? So next time you don't have to ask me when you know that this is an interest only program. Then all you have to do just to use this formula. Very easy. Now, the next one, it's amortized payment. Amortization. Amortization, oftentimes you hear something, obviously amortization program, it's you pay principal and you pay interest. Okay, you pay principal and interest. Amortization loan, you have an amortization schedule. Now, what are these type of loan? Many of you heard of something called 30-year fix. Am I right? A lot of you heard of 30-year fix. A lot of you heard of something called 15-year fix. Okay? You heard of something called 5-year arm, 10-year arm, so on and so forth. What does it mean? When we say 30-year fix, it means that the loan is good for 30 years. The interest rate would not change for the next 30 years. That is 30-year fix. When you see something called 10-year arm at 30-year amortization, what does it mean? First of all, what is ARM stands for? What is ARM? ARM mortgage stands for
Adjustable rate mortgage.
adjustable rate mortgage. Thank you so much, Benny. Yes, absolutely. Adjustable rate mortgage means that the rate can change. So for a 10-year arm, meaning what? The first 10 years is not going to change. And after that, it's going to change every single year. That is called an arm. Now, at 30-year amortization, what does it mean? It means that the monthly mortgage payment is calculated based on a 30-year amortization. That's what it means. 5-year ARM at 25-year amortization. Exactly what it means. It means that this is a 5-year ARM for the first 5 years. The interest rate is going to be fixed. It does not change anything. But instead of a 30-year amortization, now we have 25-year amortization. Now, oftentimes for 25-year amortization, you see it on SBA loan. Okay, you see it on many commercial properties like retails, office buildings, so on and so forth. For the 30-year amortization, oftentimes you see it with 1 to 4 unit investment properties, mixed use. You see it in an apartment building, so on and so forth. So those are the different type of loan for amortization payment. Now, this type of loan, because every single payment, the payment is the same. Okay, the payment is the same, but the interest and the principal is different every single payment. So somebody asked me, "Hey, Alan, if I paying $2,000 a month," well, first of all, if I have a $300,000 loan at 6.5% 30-year fix, what is the monthly payment? I have no idea. I cannot calculate. I doubt anybody, well, unless you are very, very genius. I doubt 99.9% of human being cannot calculate in their head. You have to use a mortgage calculator to come up with that number. And even further, a lot of your client will ask you, Leon, I am paying a $300,000 loan at 6.5% interest rate. Give me a table, break it down for me. How much I pay interest, how much I pay principal. Geez, in the old days, I bet the bank is going to take days to make that calculations, right? 6.5%, and if you change the interest rate to 6.551%, everything changes. But today, thank God, we have something called mortgage calculator. So it's also very, very easy for you to do. So again, let me show you. Anybody can see my Google screen? Yes or no? Okay. So
Yeah.
one thing I suggest you to do when you go into a mortgage calculator, amortization, okay, 30-year fix. So this is what you do. You go to Google, you do a search on mortgage calculator. You just type in mortgage calculator. Now this thing will come up. Okay, this thing will come up. Now all you have to do is just put in your loan amount, 300,000 and 30-year fix. And if you want to do 20-year fix, you want to do 15-year fix, now you can play around. So let's do 30-year fix. Okay, 30-year fix. And let's say the interest rate is 6.5%. Okay, now you see 6.5%. Now the interest rate is what? I mean, the monthly payment is what? $1,896. Now versus before, what is it? $1,625. You see that you pay a little bit extra every single month. Now, that is what you tell your client if you are a 30-year fix. This is how much you need to pay. Now, what is this payment include? One more time, including principal and interest is what we call a short called PI payment. PI payment, principal and interest. Now, there's something called PITI payment. What does it mean? Principal, interest, tax, and insurance. So now that is why on the scenario form, what do we ask you for? In the scenario form, right? So if you go to your scenario form, you go to 1 to 4 unit investment property, apply now, okay? So we're asking for what? We ask for your hold up. So we ask for uh tax and insurance. Um Jesse, if you don't mind, can you mute yourself? Right? So again, that's the reason why we want to get tax and insurance so that we can calculate what the PITI mortgage is, right? So again, that is how you do the calculation. You use a mortgage calculator. Now, what if somebody's saying, "Hey, give me a breakdown. on how much of that 1896 goes to insurance, how much it goes to principal. How do you do that? So now, same thing. You do a calculator, you do you do a Google search on mortgage calculator amortization. Okay? Now, the one that I like to use is called bankrate.com. So, looks like this. Normally, if they don't ask me, I use Google. Much, much simpler. But for they want to ask me for the amortization, I use bankrate.com. So you see the amortization calculator right here. Same thing. You put in 300,000 and you put in 30 years, interest rate is 6.5%. Boom. Now you do a calculator. You see? The payment is what? The payment is $1,896. Exactly the same, right? But now look down here. You have the amortization schedule breakdown. If the loan starts in October 24th, it will tell you in October 24th. Now, what is the total payment? $1,896. So on November, out of that 1896, $271.20 goes to principal. $1,625 goes to where? Interest. Now you look at the next month, December, a little bit more goes to the principal. A little bit less goes to what? To the interest. Now you do the same thing for 2025. Now it breaks down to 12 months to tell you exactly how that $1,896 actually divided into interest and principal. So if you don't know the formula, I don't know the formula, okay? It's crazy to calculate, but utilize tools like this to do a calculation for your client. I suggest you to play around and even with your own house. I bet that many of we all own our own house. How much payment are you paying? Play around with this number, and now you can tell exactly every single month that payment, how much goes into the interest, how much goes to the principal. So now, if the client is asking you, hey, can you give me a payment schedule like this? Normally, what I do is that I say, well, I cannot give you a payment schedule. But again, here is the link to the online calculator. Punch in some number, it's all there. Easy enough? Everybody have any questions regarding to how to calculate monthly payment? It's pretty easy, pretty straightforward if you know how to do that, right? So again, this is a very, very good tool for us to use.